So for those of you that have just got it started, maybe on your 14-day free trial, I want to encourage you to take advantage of the 4 steps that you see here. So you see that you have on the trial account, you can access the quick start guide. You can go through a variety of free flash tutorials to help you get more familiar with the tools in the site. You can access the free webinars and sign up or register for our next online live webinar as well. And trial members and subscribers can schedule a coaching session at any time. So the coaching session, what that allows you to do is essentially a 35 to 45-minute phone conversation with myself or Ernie. We'll walk you through the we'll walk you through the tools on the site or answer any questions that you have, similar to what we're doing today, but it's a one-on-one topic and a one-on-one conversation. All right, so got some questions coming in, and our first question comes in from John. And John says, I'm thinking of opening a married put, RadioActive Trade, perhaps on MTCH. Would appreciate your second set of eyes on it if possible. Okay, John. Well, what we're going to do is walk through what I would do when opening a married put position on a stock that I don't know. I'm going to look at the structure first of what I prefer to do following the radioactive trading techniques, and then I'm going to look at the stock and give my sort of eyeball insight if I think it matches what I might use for my specific criteria. So, what are we talking about here? Married put is a simple strategy. In a sense, it's nothing new. It's been around for a while. Married put consists of buying shares of stock and buying a put option to control the risk to single digits. Now, a common way this is taught, of course, is to buy the stock, buy a 1 month out of the money put for a cheap price so that you have a low cost into it, but the stock may need to fall 6, 7, or 8% before the insurance policy kicks in. So your risk might actually be 9 or 10%. What we teach in the blueprint, the full work that discusses the limited risk trading techniques, the 12 different income methods to use, is a way to put time on our side, control the risk better by going further out in time and buying a put that's in the money, that's above the current stock price. Now, as a general rule, if I just go to the search right now, I'm going to go to the main search right now, and we show the default criteria here that we would use to open a new married put. We want to go at least 150 days out in time. We want to keep our risk to single digits. Don't want to go too deep in the money. There is such a thing as too little risk. If I only have a 0.5 or a 0.2% risk because I went deep in the money, now my expectancy of profit is too small. I want to be somewhere around the 5, 6, 7% range as well. Now, of course, in addition to that, you see that we're looking for specific stock criteria that match the bullish trend that we want to see. And we can make subtle adjustments to this as well. For example, one thing that's put in the default search is looking for stocks between $9 and $200. That might not match my exact preference for my portfolio size. So one of the first things I personally do is I'm going to change the stock price to be maybe between $9 and $85 to match my portfolio. And at the same time, I might drop this risk down a little bit to maybe 8.5%. Not a lot, but typically don't go above that. All right. So these are the trades. These are the married put positions that I would pick from today following the radioactive trading techniques if I was opening a new married put, which I'm likely going to do next week. But John has a different situation. He has a particular stock that I don't know. So first thing I want to do is I'm going to go to the search by symbol tool under the married put tab. And this is available for most strategies on PowerOptions. We're just going to put in my symbol, MTCH. Now, I don't know the expiration cycles yet. I don't know this stock. I could look at the option chain quickly and find it, but I'm just going to run it here. I'm going to set my filters to more results and see the different trades that come up. Now, what am I looking for here? Over here, I see the put that I could buy, the cost for the position, and the maximum risk. The first one that stands out is September. Why? Because I want to be at least 150 days out in time. So I'm looking for the first expiration date that's at least 150 days. So I've got September, And I've got January, 308 days out in time, and January 2021. I'm going to stick with September 1st. There's nothing wrong with going out to January. First things first, let's take September, 189 days out. This stock does not offer an August series. Now I've got all these positions here, and the stock's trading at 55.06. Now remember what I said in the beginning, that in general, I like to target the 5, 6, or 7% range. So right away, my eyes are sort of gravitating towards these values. From the 55, the September 60, the September 65, and the September 75. Okay. Now, more than likely, I'm probably going with the 60 strike. Why? Well, the 55 strike is too high of a risk. It's 11.5%. I don't want that. You see, we talked about the out-of-the-money ones that are cheaper. Well, they take on a higher risk. I want to keep it to single digits. The 75 is good at 4.2%, but that's almost 20 points in the money. That's probably too deep in the money, as is the September 70 here as well. So those two are probably out. So I'm going to pick between one of these two. Now, before I do that, I have a stock at 55.06. I can take a 7.6% risk with the September 60 and a lower risk with the September 65 with only 4.8%. Earnings date's 53 days away. That's just something to know. But what do I want to do now? This is a different situation. John's aware of MTCH. I am not. So I'm now going to pick one of these two. But the first thing I want to do is I want to take a little bit deeper look into the stock. What are some of the things I want to look for? Let me clear those drawings out there, and we'll go back to that page in a moment. Well, I want to make sure I have a positive earnings per share growth. That's good. We're at 32.6%. Stock doesn't pay a dividend. That's fine. It's not one of my requirements, but I like to know it ahead of time as well. Now, I'll usually look at this at a stock chart, but right here I'm a little bit concerned on the negative MACD signal, and that the stock is trading below its 50-day moving average. I'll show you what I look for in a moment. Other than that, nothing really stands out to me here. I have the other information. We're in internet content and information, excuse me. We've been 11 days below the 20-day moving average. I'm sorry. Yeah, we were below the 20. I said that wrong. Above the 50. That's good, but we're still below the 20. It's right at it. That's a little bit of a concern. Okay, but it's been up the last day. Now, that's good to know the knowledge. I usually keep my focus right here in the center. Volatility, of course, is a good range. Now, I'm going to go to big charts next. Now, I just want to take a look at the chart. Now, I have big charts set for the things that I typically look for that didn't save because I cleared out the cookies. So what I typically look for is either a 3 to 6 month chart. And I'm going to go ahead into the indicators here, and I want to see the 20-day moving average. Why is because I also like to look at the Bollinger Bands. I want to take a look at the MACD personally. You can set this up any way you want. I'm also going to use RSI and volume. All right, well, let's just go ahead and draw the chart and see where we are. So I'm going to change it now to a 3-month chart. We see what the stock's done. It had a good rise here. It pulled back in February, March. It's hit the bottom of the lower Bollinger Band. It's trying to come back up to get above the SMA 20. The MACD is negative, but it's trying to reverse. I'm going to switch now to a 3-month chart to make that a little bit more clear. Let's actually, John, go with a 2-month chart. What I typically prefer to look for is seeing the positive crossover, not the negative. Right? This is when things started to decline at the negative crossover. I'd actually wait to see this crossover and the stock be above the SMA 20 to confirm sort of a bullish signal. If you think that might happen, that's fine. But again, that's typically what I look for. I'd want to see the positive MACD. It is coming back up. You can see it's sort of leveled off, but it hasn't crossed the signal line yet, the EMA line. RSI is moving up, and the stock is getting closer to the 20-day moving average. It's just not there yet. So those are some things that are kind of a concern for me at this point. Technically, doesn't mean it's a bad trade by any stretch of the imagination, I look for stocks that are above the SMA 20 and have a positive MACD crossover within the last few days when I'm looking to open a married put position. Okay, now, all that aside, let's go back. When I open a married put position, I'm going to leave this, let's go back to that 2-month, 3-month chart, maybe 6-month. All right, when I open a married put position, when I select from that list that I showed you, after I make a couple adjustments, I'm going to go through the same process I'm going through right now to pick my own trade. I'm going to look at the stock information, and then I'm going to look at the chart here, and I'm going to look for things that match what I want to see. What am I really looking for? I'm looking for a stock in that list. It already has the risk we want. We put that in. But I'm looking for a stock that I feel has the potential to move up 3 to 6% in the next 20 to 40 days. Right? It is a bullish strategy. And if the stock does move up this 3, 4, 5% in the first 20 to 40 days, I'm likely going to be able to do an income method at that time to hopefully cut the risk in half. Possibly income method number 4, one of the 12 income methods, maybe another one. So I guess, John, your thought process here is that the stock has come down, leveled out, and is starting to move back up. And you think it still has the potential to show this movement over the next 30 to 60 days before it hit this trouble point and sort of receded back down. Okay, there's nothing wrong with thinking that. I'm just pointing out of what I would look for in this case. I want it to be showing me that it's above there and has the strength, and I want to see a positive crossover as well, like we saw back here. And then another little one sort of here, and then with a negative crossover, that might have been a signal to maybe get out of the position or do some premium against it or whatever. Do another income method, maybe income method number 12. Okay. So I'm not overly confident right now with the strength of this stock. So if I were to open a married put personally, I can tell you right now that I'd be torn. I'm likely going with one of these two choices, the 65 or the 60. Normally, I would go with the 60 because it's closer to the current stock price. What did I say? I wanted a 5 or 6% move, which would put this up to maybe about $57.50 or $58. Not above 60 yet, but close enough to where I could really feel confident, get good premium doing one of the 12 income methods. The 65 carries a lower risk. It's only 4.8%. That might be a consideration, a strong consideration, because I'm not 100% confident on the stock yet. But that's my opinion, not yours. Okay? Excuse me, folks. And I was just following up with something here. And Sam commented, he said, below the 50-day usually means a sell unless it starts to go and recover. He says, maybe going up with the market might not be as strong as well. We saw the positive earnings there. Okay. And Sam also points out his chart reading says he sees a double top at 60. Okay. All right. So that's a concern that might lead you to the deeper in the money, higher cost, but lower risk married put. I usually tend to stay in the 5.5 to 7.5 range, so I'm probably leaning towards the September 60 because it's closer to the price and I might be able to do an income method faster even though the risk is higher. But before I make that decision, I'm just going to check out January, the 309 days out that we saw. See, this one has a 58, but it's a 14% risk. That's beyond my bounds. The 65 here is at 9.4. I'd still want that to be below 8, and I don't want to go to 70 even though I have 308 days out in time. So, by my personal, and it's right on the cusp of we don't want to go more than 20% in the money, and to get that risk of 8%, I'd have to go to the 70 strike, which would be more than 20% in the money, or the 75. I don't like it. So, I'm sticking with September, and either one is fine. To tell you the truth, either one of these two is a perfectly fine married put radioactive position, the 60 or the 65. You have to ask yourself now going in is, are you confident in your stock selection for this particular one, John? And I think I said Jim a couple times. I apologize, John. But are you confident enough in your selection that you think this is going to be a good moving neutral to bullish stock with things coming up and an earnings coming up in 53 days. If you are, then the better choice might be the higher risk closer to the current stock price, the September 60, because you'll be able to do income methods sooner. If you're concerned about the risk, if you're concerned maybe that you're not 100% that the stock's going to go up, you feel that this is a good stock to enter, you want to control your risk, you don't want to take too much, then you might go a little bit in the money at the 65 and be safer. 75 and the 70 are too deep in the money. They're beyond that 20%, and as we talked, the 55 is taking on too high of a risk. Even though it's right at the money, I wouldn't consider that. So those are my two choices. The next choice is up to you. I can't really say that. So what could I expect? Well, now that I've gotten to this point, I could go to the profit and loss chart. And what am I going to do here? Now, see, it's showing me at the midpoint, the risk is only 6.9%. That's even a better sort of idea here is why I might go with the 60, because I am under 7% in this case. But in this situation, what happens if we do get our 5% movement, 6% movement? Let's say the stock goes up to $58 by the end of the month. Well, maybe around April 10th, let's say, April 13th. April 12th. Sorry, April 13th is a Saturday. I forgot that. All right, so let's go ahead and calculate that. What would we expect? Well, we're going to lose some money to the put, but we are going to have a gain in the stock. Remember, our break-even is 64.45 at midpoint, but that's only the break-even at expiration. If the stock moves up, if I entered this trade today and the stock moves up 20 cents tomorrow, I'm still probably at a 10-cent profit. Break-even is the only, break-even is just the break-even at expiration, okay? In that case. All right, so Sam, I'm going to get to your other two comments on this in just a moment. But this gives me a gauge of what I could expect. Another thing I could do, of course, is say, well, if the stock goes up to $58 or so in the first 30 days by April 12th, then I know at that point, well, can't look at it real well here, but after March, the May series will be available. So I could almost expect to get, maybe if the stock's at 58 for the 60 call, I could almost get maybe $1.60, $1.40 based on where I'm seeing the prices right now for 34 days out. So that's projecting a little bit, but I can't run a what-if scenario on the May option because it's not there. All right, so, but we can use the what-if scenarios. I'm not going to sell a call right now because the April 60 call is only 50 cents. If I expect the stock to move up, I'm going to let it move up to where I can get a better premium here at the 60 or maybe even the 65 strike rather than just getting a few pennies, a few dimes here for selling it too soon. Okay, that's part of the radioactive trading concept. So again, the structure is there. You saw the two strikes I would choose between. And you saw my concerns about why this would not come up in my search as a married put position. Not even the default radioactive trading search, but also if I was using no stock list and just looking for the technicals because it's just under the 20-day and it's not showing the positive MACD that I want. Let me store the chart settings real quick. So I'm going to go back to the search this time, John. I'm going to make those subtle changes I did again. And remember, the same functionality you're seeing here where I can change things for risk, return, stock technicals, stock fundamentals are the same criteria you could change if you were looking at a covered call, bull put credit spread, bear call. The tool is extraordinarily flexible. I'm going to put my risk back down to 8.5 as the max. I'm going to put my stock price in to 85. That would have matched your criteria. But what I'm also going to look for as addition to, I'm going to look for a stock above the 20-day and where I've crossed a positive MACD signal, let's say in the last 5 days. Over MACD cross signal blank to 5. Let's see if anything matches. Nothing. Okay, so let me try this real quick. I'm going to open up the universe of options. I would normally stay with a selected list that we use for radioactive trading. There we go. All right, there's an interesting one. I saw some things about that in the news today about Shake Shack, of course, how they're thinking of changing it. First Solar's in here too. That's an interesting one that I've been keeping an eye on as well. So let me go here. Even though they're both down, the two that I pointed out are both down today, this is the kind of stock chart I'm looking for. That MACD cross is not really strong yet for me on this particular stock on First Solar. It is, but it's not. It pulled back today, and that's a little bit of a concern, but it is above the 20-day. You can see it has been moving up gradually. It had a little hiccup today, but it's had a few hiccups in the past. I go back to Shake Shack. Let's see, this one too is just recently crossed over, which is good. That's what I'm looking for. I should just keep this at the 2-month. Sorry about that. There we go. See, the MACD is trying to cross over, but the RSI with the weakness today. But you see it just crossed over the 20-day, just had the MACD crossover, sort of went up over the Bollinger Band. It's trying to break out of there, but it didn't look like it could hold it. But that's something that I'm kind of looking for here. CF Industries, one last one, ladies and gentlemen, and then we'll move on to our other questions that came in. Not quite, but good. So this is one that's recovering. I'd probably want to see something a little bit more active. Okay. I do have 3 pages of results. Let me do something a little bit different. Let me look for a more pronounced trend. Usually I like to see a recent crossover, but let us look for a more pronounced trend. Positive MACD. Gray Television is up there. Lionsgate, interesting. Activision, also interesting. Let's take a look at Activision. They have had a fall off recently, but they look like they're starting to recover a little bit. So that might be an interesting thought. Remember, it was up in 80 and that had a huge letdown, as most stocks did, from October to December. And it never fully recovered as some other stocks did. But it's kind of what I'm looking for. I'm just trying to see if I recognize anything that's been in the news. There we go. That's a little bit better. Even though it's pulled back off the upper band, I like what I see here on this particular one so far, with protection in place, mind you, not just as a long stock position. But we had a Bollinger Band breakout here. It sort of pulled back from it and then started to move back up. Yes, the MACD looks a little weak. The RSI is pulled off. But IMAX might be a consideration for recently crossing over the 20-day, showing that positive breakthrough. Here would be a great entry point, right? This would have been when it just crossed over the 20. That was, of course, due to an earnings something or some good news that came out. But that positive MACD would have been a decent time to get into the position. I think this may still have some more growth left in it, so I might check that out on Monday as far as opening a new RadioActive married put position for our Fusion subscribers. Run this search again and see what comes up around midday and see what new position I'm going to open. But John, that is my approach. I'd stick with September because I didn't like the prices in January. I'd stick with the 60 or 65. Following the rules in the radioactive techniques, you saw why. Those other strikes were too deep in the money, so they would have been filtered out. The risk is where I want it to be, and more. Now, a common question comes up at this point, and Sam brings it up as well. Sam likes to mitigate his risk by mitigating cost and also by, at the same time, applying proper position sizing. So, this married put on match group, I could enter it with 100 shares in one put and it would cost me $64.45. The worst case scenario is a loss of $445, just under 7% risk, which really you only take if you hold the position all the way to expiration and your stock is below the put strike price. See here, in the next 20 to 30 days, if the stock stays at 55, you might only be at a 0.8 or a 1% loss because you still have 150, 160 days of time value remaining in that put. It's still right a little bit in the money. Okay, so there's not a lot of risk in these positions. Even if it gaps down 20% in the first 30 days, I might not be near this maximum risk. I might only be at a 5% or maybe a 5.5% risk, still not at the full 7% risk. But going to Sam's comment, he says, why not open a September strangle or straddle? And a lot of investors ask this as well, say, well, why am I going to put this money in? Instead of buying the stock, can I just buy an in-the-money call to mimic the stock ownership? Well, a straddle or a strangle is a certain approach that can be used. You want a little bit more movement in the stock in that case. Why? Remember our numbers. 445 monetary risk on this married put with about a 6.9% and a $6,445 initial investment. Let me wipe that clean. Let's go to September series again. So I'm a couple strikes in here with the 60. Let's drop down a little bit in the money and go to the 45. It's about 10 points in the money. And it's priced at about 13.80 is going to be the midpoint. Why is that important? Well, because there's $3 of time value here on this call option that's in the money. It's going to have a high delta, but it's not going to be a delta of 1. You'd have to go really deep in the money to get a delta of 1, and even then, you're still adding 80 cents, 90 cents to $1 of time premium. Why is that important? Remember, the sole reason about the married put techniques is to control risk to single digits, to avoid the lie of leverage. And if I take a 5% risk on a position, I only need a 5.3% gain to get back to break even. If I take a 15% loss on a position, I may need closer to a 30% gain to get back to break even. If I take a 33% loss, I need a 50% gain on my next trade to get back to break even. How often do you get 50% winners? Well, Sam gets them fair enough, often enough, I should say. But I'm going to put that back in. A 15-point difference on the strangle here, Sam, not the straddle, because I'm using this as one of the common things that's asked about the married put. I'm only putting up a third of the value, $2,330, as opposed to the married put at $64.45. So I'm using leverage to get a better cost. The risk has doubled, close to it, but from 445 to 830. Why? Because now I have to fight the time value of the put and the time value of the call. And the percentage risk is 35.6%. The stock waffles between 45 and 60 for the next couple of months. I start to lose the time decay. I might be at a 15, 20% loss, which means what? I'm going to need a 33, 35% gain on the next trade if I close out early because it's not doing what I want in order to break even. The married put is a neutral to bullish position. This is bullish or bearish. The one thing you don't want is neutral. Well, the married put is more of a bullish position. I should say that before someone catches me on it, but that's the benefit of the blueprint with the 12 income methods, because even if the stock stagnates, there's adjustments you can use to lower this risk even if the stock is not moving in your desired direction. Okay. The flaw in this theory of using what's called an in-the-money long strangle, buying an in-the-money call with a high delta to get a lower cost basis, it is 1/3 of the cost roughly, right? But the problem with the in-the-money strangle is that you're now fighting two time values. The risk goes up a lot, almost double in every scenario, in most scenarios you look at, I should say, most scenarios you look at. And this is out of bounds for the whole purpose of what we're doing with radioactive trading technique. Now, Sam is very conservative in the sense that he's trading straddles, he's trading strangles and things of that nature, but he does what I do. If I open that married put with a maximum risk of $445, I do the number of shares and number of contracts so that this monetary amount, the total amount at risk, does not represent more than 2 to 3% of my total portfolio value. Sam might open this strangle, but he's going to make sure this $830 does not represent more than 4 or 5% of his total portfolio. So even in the worst case, this stagnates and does nothing, and the volatility collapses and he loses time value, worst he could do is lose a small percentage of his portfolio. That's talked about in the blueprint for the married puts and is very key. Okay? But here, though, we're back to that 35.6% risk. And if I take that 35.6% risk, I'm probably going to need about a 53% gain on my next trade just to break even. It's not where I want to be. We want to stay in that single digit, so even if I lose 5.5%, I only need a 5.3 to a 6% gain on my next position to get back to break even. Another rub here. This is not a delta neutral trade. This is delta opposed. What does that mean? It means I need a larger movement, even in the short term, in the next 20 to 30 days, for the gain in the call to start countering the loss I'm taking on the put. Whereas within the married put, I have a positive delta on the trade. This is a small positive delta, but remember the stock has a delta of 1. Put probably had a delta of negative 0.6, so I still have a positive 0.4 delta. Here I'm probably only looking at a positive delta of maybe 0.15 or 0.2, meaning I need a larger movement before I start seeing a profit. Every example I've run for customers comparing the married put RadioActive Trade to using the in-the-money long call as a substitute. What we typically see is if the stock moves up 2 or 3% in the first 30 days, sort of that target, I'm going to have a profit of maybe 1.5% on the married put position. The in-the-money strangle is still going to be at a loss. Because the gain in the call has yet to counter the gain in the put, I need another 2 to 3% movement in order for that to happen. Now, the argument against my argument is, yeah, but here you have 2 ways to win. The married put only gives you 1. Well, that's where the income methods come in. Of course, you could do adjustments inside this straddle anyway to also lower risk, but it gets dangerous. Okay? I'll show that in a moment. But here you have 2 ways to win. That's true. And you could say, well, look, if the stock shoots up to 75 or 80, I'm going to have a much higher profit, both monetary and percentage, likely on this in-the-money strangle than I would on the married put. And you're right. You're absolutely not wrong. But if I was specifically looking for stocks that I felt might have the potential to move up 10, 15, 20, 30% in the next 20 to 40 days or 30 to 60 days, I would have used a different set of criteria. Okay? The stocks I was looking for, as you saw in the charts, are gradual movements upwards with the potential to exceed my expectations, which I like. But that's not the type of stock I want for this strategy. Simply substituting a long call to lower the cost basis total to use leverage doesn't mean this is a better trade, because it's probably not the right stock. The right stock that I was analyzing for RadioActive Trade is not the right stock to use for this strategy. This goes back to another point that Sam made, and I'll just shoot that out there, John. It's not direct trading advice, but Sam said, you know, Apple looks to have more power right now than Match Group. Maybe you should consider a trade on that. Or Sam said, maybe you should consider a 3-month out strangle or straddle on that position. Well, what Sam's going to do is maybe do that, a straddle or strangle on Apple that he feels has more power, because this is a strategy to use when you're expecting larger movements and larger strength. And you can make adjustments, roll the call or the put as the stock moves up or down, sell premium against it, and more. Now, I had mentioned that, yes, you can still do adjustments on this in-the-money strangle, which I don't ever advocate as a substitute for RadioActive Trade, and now you know why. You've seen the 3 reasons why. The risk is doubled. The percentage at risk is way beyond what we're looking to do. It's delta opposed in the beginning, not delta neutral. It's delta opposed. So even though you can win 2 ways, you need a much larger movement one direction or the other before you start realizing a profit. And yes, you could do adjustments on this, but you can get yourself into trouble faster using adjustments on this in-the-money long strangle that would work in a RadioActive Trade. First things first, we saw a moment ago that if I did have the stock, if Match did go up to $58 on or around April 12th, we would have a gain of maybe $100, $105 in the married put. So let's take that same idea. This might be a profit, actually, based on the structure I'm seeing right now, but it might not be. Nope, not at break even yet. Why? Because the gain in the call has not countered the loss in the put. It's delta opposed. I need another 2 or 3% movement, just probably not even that much in this case, but I'd need it to maybe be at 59 or 59.50 to see a $27 profit. At 59, I'm probably at $150 to $200 profit on the married put. Here I'm at 27. But of course, if the stock goes up to 80, you're talking about a severe profit. I'd have a severe profit on the married put too, but a 50% gain, a little bit more than 50% on the $2,330 you paid. Was I looking for a stock that I expect to jump 25 points in the next 30 days? No. Okay, so that is the other fourth reason why we never advocate the in-the-money long strangle in place of a married put. Finally, you can say, this is the last thing, we'll get to other questions, you can say, well, just sell a call now, and you can reduce that risk. What's going to happen when I sell a call here? In a married put, if I sell a call, income method number one, I sort of create a dynamic collar that has a reasonable profit of maybe 3% here. I reduce the risk from that 6.9% we saw, maybe down to 4.5% to downside. And I have a peak profit and loss, and then it would taper off a little, but it probably won't enter back into the loss zone. What's going to happen when I sell a call here? It's going to give you a completely different position, not related to the collar at all that we see in the married put position. So let's just say I go in at 60. Oh, you know what? Let's go out to June even. Let's get as much premium as we can halfway between now and our September series. Let's go to the June 60 at 265. That's going to cut down a lot of that 830 risk, isn't it? Well, in one direction. Whoops. It's going to do it in one direction. It's going to add to the risk in this scenario. Why? Because you get no more advantage of the long call, and as the stock moves up, the put just tends to decrease. Yes, you did reduce the risk, but it's 527. I've already lowered my risk on the married put, and I have further upside. I don't enter a loss to the upside. That's why it's dangerous, because you sell a put, sure. Now you've got a calendar put spread and a long call, but again, it's not the structure you were looking for based on the original position of saying, hey, if the stock goes up to 75.80, I'd have a much higher profit. Here you just entered into the loss zone because you capped the gain. It doesn't work the same. It's not a parity trade. Okay, it's not that structure at all. That's why you don't want to use the in-the-money long strangle as a substitute for the married put, because you're looking for an entirely different stock in this situation. And then you have to be careful how you manage it, because you can cap your gain in one direction or the other and actually increase your losses on the stock, even if it moves the direction you thought it should go. Okay, so there's nothing wrong with what Sam said to do. Okay, there's nothing wrong with using straddles and strangles as part of your portfolio, but you're not going to look for a married put based on what we would look for in a married put structure and then try to apply it in the money long strangle for it, because that's not the type of stock you want. All the research and analysis we did leading up to John's question was to identify a good married put position to match expectations for that strategy. Trying to change it at the last minute and saying, oh, well, if this worked and in the money long strangle will work, now you need a completely different type of stock for that kind of strategy. And this isn't it. Okay, all right. So again, all of what we talked about today and more, for those of you that don't have it yet, is available in the blueprint. You can just go to the products page and check that out for more information, or of course email me at any time. Reviewed Sam's questions there. Okay, sorry. Sam sent me Sam did email me a question earlier this week, I believe. Is this what we were talking about? If you did it just before the webinar, I missed it. But Sam was looking at sort of a credit spread on MSFT. And what you have here, Sam, is that I did send you the trade MSFT. I did not take the trade, but wanted to know your thoughts. I did reply to the email, at least two of your emails this week that I saw. One of the emails I saw this week. I only saw one. I replied to it earlier this week. But you were saying sell the 130 puts and buy the 125 on MSFT. Oh, right, this is the one I talked about. I forget the expiration date, maybe March 29th. And now I remember it. Buying the 125 put, selling the 130. I did respond to this. If you didn't get my response, I'll try to resend it, Sam. Right away, you probably already know my thoughts on this trade. So what are we looking at here? Sam is looking at, well, now he's got a better position. If you get the midpoint, highly unlikely because these things are out of whack now. That's a 4-point bid-ask spread there and a 4-point bid-ask spread here. I don't think those bid-ask spreads are reasonable. Okay, why do I say that? Well, at the midpoint here, it's showing me you're getting a net credit of 520 on a 5-point strike difference. Market maker's not going to let that happen. This is going to be a debit, and I think your debit was 480 if I'm not mistaken. No, my apologies. Your credit was 480 if I'm not mistaken when you originally sent this to me, maybe 470. Okay, let me take a look here. So in any case, this won't happen. A no-risk credit spread won't happen. The market maker's not going to let you get filled at these prices. Okay, you're probably going to be closer to paying $10 here, and you might only be getting $14.40 or so here. Okay, so let's just do that. That gives you a $4.40 debit. Credit, $4.40 credit, so risk of only 60 cents. Okay, this is an out of the money, deep out of the money, bull put credit spread. And in my email response, Sam, I told you I would not do this, and I think you know that. Why? Because I'd rather look at the out of the money bull call as a parity trade, where I'd be selling the 130 and buying the 125 call, hopefully for only a debit of 60 to 80 cents perhaps. So I'd have a similar risk-reward profile, risking 60 or 80 to make 440 to 420, needing the stock to move up 15 points in the next 15 to 18 days in order for that to come to fruition. Low risk, high return, probably only a 10% to 8% probability the stock would be above 130. So why am I saying I wouldn't do the bull put? Because you're starting off with a deep in the money put option. This can be assigned at any time. Yes, you have the 125 put, and you can agree to exercise that put to sell to close it. Okay, worst case scenario is you get put the stock early and then the stock falls and then you don't get as much instantly for the 125 as you needed to. Okay, you're still going to get a good amount, but you don't get what you wanted. Or you just take the $60 loss in this case and say, hey, that's enough. One of the other things that you have to consider in this scenario with this deep in the money put, it might not be a major concern. This is out to March 29th. I'm sure you've already looked at this, but I want to show one of the other risks with this trade using a deep in the money put. Wouldn't affect you. All right, so the next ex-dividend date is 5/15. My concern was if the, oops, sorry folks. My concern was if the ex-dividend date's coming up, if you get put the stock, oh, well then you'd get the dividend. I'm sorry. I was thinking in reverse. I was thinking of the calendar call spread where our customer ended up being short the stock because they forgot that the ex-dividend date was coming up. Their short call in the calendar was in the money. They were put the stock early, then had to pay the dividend, and then the stock fell. So the long call, they could still use it, but at that point, the long call was worth less than it was when he was assigned the stock, and he had to pay the dividend, so that even lowered the cost basis further in that case. So is the bull call debit worth it? Is it similar at all? That would be my first consideration. So instead of being in the money with a 130 put, I'm going to go out of the money with the 130 call and the 125 call. Now this looks like a normal bid-ask spread. This is still out of whack somehow, this particular stock. So I'm selling the 130, buying the 125. Okay, if I get midpoints, again, you've got to, not realistic. I can't pay a debit that would give me a guaranteed profit. That would never fly. So more than likely, this is going to be 75, maybe 80. Oh, wait, I went the wrong direction, didn't I? I'm so sorry. That's not going to be 80. That's going to be 35. Okay. Still not realistic. Buy's got to be, yeah, the buy looks right, though, 10 to 40, right? Well, so in any case, this is not realistic. You won't have a no-risk trade, but it's a very similar risk-reward profile that we were talking about, Sam, but now you're out of the money with the call. You don't have to worry about having your short option exercised early. Yes, you have the long to cover it, but when you're doing an in-the-money bull put, I would just take a look at the out-of-the-money bull call if that's your expectation in this position. Yes, it would require an extra commission to close the bull call if it does what you want, to close both legs or exercise the stock at 125 to deliver at 130, get the $5 back. I get it. Where the bull put would just expire worthless if it met your needs. But again, I'm not taking the risk of selling a deep in the money option. I'm out of the money with the call and out of the money bull call spread. That is my answer. I'm not saying this is a trade I would do or that I think it's a good trade unless you're really, really bullish on Microsoft, which you have to be to do this. And you might have been in April when we were looking at this in that case. Okay. So that was my thoughts and what I emailed you earlier this week in regards to that, the bull put here as well. Okay. All right. In the money bull put, I should say, versus out of the money bull call. Okay, I'm going through the questions real here. Okay. Lynn's comment, I'm sorry, this can't, Lewis comment, I'm sorry. Why can't, oh shoot. I think I just lost it, I'm sorry. Okay, there we go. All right. Yeah, I mean, the trade might be making money, sure. You have a debit call at 112, 117 on Microsoft. Okay, this is just the idea they're avoiding the early assignment. Some of the questions got moved on me. I apologize. There it is. I'm sorry. Louis, why can't you just use the signature tools to find OTM Microsoft calls? Yes, you could use a spread chain to do that. You've made good money so far already using your best call finder. Fantastic. So what Louis is talking about there is two tools that we offer. The signature tools, one is the spread chain. And we were talking about MSFT, my apologies. And I'm going to go to the put credit and call debit parity, set my strikes to 5. Sets my probability from 8 to 28. I know that seems strange. Return 100. There we go. Okay. So these are close. There's your, oh, I didn't go far enough out, but that's okay. But here's some of the other positions. What Luis is referring to is on the spread chain. What I'm looking at here is the call debit and put bet debit parity. And here you're looking at the bull call debit spread prices, the returns, okay, the midpoint price premium, the spread cost, and over here the bull put credit spreads. Same probabilities, but the returns. So in this case, every bull put now at midpoint is beating the bull calls. Okay, but this is the tool I would use to compare them quickly. I didn't in Sam's case because I just wanted to go on the fly with the custom spread tool. But this is a tool that's very useful. If you're interested in a bull put credit spread on a particular stock, you can link to the spread chain from the searches or from the other tools. You can click on put credit and call debit parity. And what do you look for here? Well, if your return on your out of the money bull put is say 11%, but the same strikes and same probability on the debit spread at midpoint happens to be 18%, maybe I'm going with the bull call debit for more bang for my buck because they are parity trades with the exact same risk-reward profile. Okay. Now, and the other thing Louis was talking about is that if you have an expectation of where you think a stock's going to be trading, for example, we'll go back to our example on Match Group. If I had the anticipation that Match might be trading at $58 in the next 30 days, we're going to use that long option finder. All you do is plug in your stock symbol first, your expected price. I think Match might hit 58. This is not a recommendation or suggestion. This is just based on what we analyzed before. Put in $1,500 maybe to some calls, maybe a little bit less, maybe 1,000, and on April 12th. In that brief instant, what this tool did is grabbed every available option on Match Group, grabbed what its current price was, how many contracts we could buy based on our investment amount and what all these options would theoretically be worth on April 12th if the stock hit our target, and our winner, the option that would give us the best return, theoretical return, highest percentage if our stock did hit our target on our target date, is the April 50 call. So instead of looking at an option chain and saying, well, what would the slightly in the money call do? What would the out of the money call do? What about the Mays if they're available? What about the Junes? Which would give me the best return? Just plug in your stock, plug in your expected price and your target date. This shows you which strike would give you the best theoretical return. Does it make sense? This is April 18th expiration. My cost is $580 right now for these 50 calls, and I could buy 2 with my investment of $1,500. The stock's trading at 58 on April 12th. Theoretical value is 802. Yeah, I buy that. Excuse me, folks. $8 in the money, 6 days remaining, so maybe an extra 2 cents a time premium. Yeah, that would do it. That would be the return I would look for as well. Okay, so that's the tools that Louis was talking about there. The spread chain to compare the parity trades when you're analyzing a bull put or a bull call debit, to go ahead and look at which position gives you the best bang for the buck, and then of course using the long option finder to find positions that match where they are. Find positions that give you the best bang for the buck. And if you reversed it, put it down to 50, well then it would show you which puts, of course, would be the best ones to buy to give you the highest percentage return. The stock hit your target on your target date. Okay, now, John had a comment from that strangle discussion earlier. He said, I've heard straddles and strangles reflect what the market maker thinks the price range will be during the time to expiration. Well, that's effective volatility, right? I mean, you could say it that way, John, but why is a 50-strike straddle, buying a call and a put at $50 for April on a stock trading at $50 per share, why does it have a higher cost than a very similar stock trading at $49.98 and buying the 50 strikes, where one costs me $3.80 for the straddle and one costs me $2? Well, it's because of the volatility. And what's the volatility? The measure of fear, or the measure of expected movement, and implied volatility, I should say as well, of the expected movement of the stock. Doesn't mean it's going to do that. If I have a stock with a high implied volatility and a high historical volatility, what does that mean? It means the options are going to be overpriced. They're going to be inflated because there's more of a chance of it fluctuating. So you could say it's based on what the market maker thinks it's going to do. He's gauging that off the volatility numbers. That's why the straddle on stock A trading at $50 might be significantly higher cost with higher implied volatility than stock B, because there is an expectation that stock A could move more because of recent events and higher volatility, whereas stock B is a little bit more of a neutral movement, bullish or slow bullish movement again. Okay, I got Fernando's questions here, and I've got, oh, sure. The other comment by Luis, this is another thing I had mentioned with the strangles and the straddles, but I also mentioned with the married put positions. Luis says, you know, you don't have to wait to expiration, get out with your 20 to 60% profit. Sure, but remember how much movement more we needed in that strangle to see a 20 to 60% profit on match, because it was delta opposed to start. We needed more movement to even get to a profit than we would with the married put. But you're absolutely right. I also don't hold the married put all the way to expiration. I'll get out of that position when I've hit my target goals as well. But that is a great point. And that's what Sam mostly, in other conversations we've had, when he talks about his strangles and straddles and moving them, he doesn't typically hold them to expiration at all. He gets out when he hits his profit margin or legs in and out of those positions, which might be a little bit more management intensive if you're not willing to spend a lot of time looking at the positions there. Okay. All right, so I'm going through some of these here. Like I said, I've got Fernando's questions, and I'm just making sure I'm clearing everything out here that we've already addressed. Good. All right, so Kaushik, I'll get to your question first. Yeah, I'm going to get to your question first. My apologies. Fernando, you're up next. So Kaushik says, could you please review IQ 45 January 2020 call? Okay. So this is a position that you're in. You purchased it at $6, 45 strike. Oh man, this fell too much. Okay. I don't know how many contracts you have. It's not relevant really. Okay. So this is way beyond the bounds. Stock is trading at 27.02. Okay. I just want to check something real quick. Sorry. I don't know when you maybe if you purchased this when it was back here several months ago, almost buying a leap call like last June. If you just bought it recently when it was trading here, 45 at $6. I mean, yeah, the stock's nowhere, hasn't been near that in over a year. Not over a year, my apologies, in about 8 months. Okay, so I don't have any great management ideas for you, I'm going to be honest. The stock's down 50% below your strike price. Your option has lost, we saw that, the option was worth about $1 right now. Okay, so it's lost a fair percentage of what you paid into the position. Okay, any suggestion for defense? Well, how can you stop further losses, that remaining $100? You may want to consider just closing this out and rolling down at this point. I mean, if you think it's going to come back up to 45 and you're planning on holding it to January of 2020, you've got a lot of time, don't get me wrong. But if you think it's going to be profitable, that it's going to move back up and it's going to get to a point where this is even at the money, at some point, hopefully soon, not at January, because even if it's at the money at January, it goes to zero, right? You need it to be at 51 if you held it that long. So you're expecting a rebound, obviously you're expecting strength. If you want to protect it from further downside losses, well, you know that this is going to lose that last dollar if the stock keeps dropping. What goes up if the stock falls? It's a long put. So you could maybe buy a cheap put out in time. Not that cheap. I was hoping for cheaper, but maybe a 20, for $2. Yes, this adds to your cost basis. It's going to add to the risk. But again, if the stock keeps falling, this put might increase as your call is still declining in price. That's the defensive. Just like on a stock position, you could average down. So you could buy maybe another 1 or 2 calls at this, I know it looks expensive, but at the lower price now, say around 30 or maybe 32, let's just buy another 1 call. So now, yes, you average down. You've got a cost basis of 1107, but now your break even is 4017 as opposed to 51. Yeah, 51. Okay, so you've almost lowered your break even by 11 points. That's something you could consider. It's going to be putting more money into a position, and that's a concern. You want to make sure how confident you feel with this particular stock chart, for example. Do you think it's recovering? I'm seeing it pulling back and touching the 20-day. After a slight Bollinger Band breakout, it pulled back, so it may push back up if it gets strength. The RSI has just started to move back up a little bit. Get a better view on the 3-month chart. There we go. So you did have the negative crossover after sort of a Bollinger Band breakout. Sometimes we expect to see that, but it's holding above the 20-day. It moved up today. Might see a MACD crossover, so I don't like throwing more money into a bad position, but this would lower your break even as well. Lewis's comment is something that I was getting to next, but it also has the risk of going against you. And the comment is correct. This was the next step. So the way the question was originally phrased for defense, what defends the position? Well, if you think it's going to continue to drop and that's your concern, you add a put. If you think it's bottomed and it's going to recover, you can buy extra calls, but it costs more money. Now the comment is, let's just sell something deep out of the money short term. And maybe the comment was maybe a 35. There's no premium there, even out to April. Let's do a 30. So I kind of cut the cost basis down by selling this to create a poor man's covered call. But you're not doing a poor man's covered call in a sense. You've created a bearish credit spread in this case. This is bearish, not bullish. And Louis, I'm sure you've heard me say it before. I just don't like that term poor man's covered call because it says, hey, you can get the benefits of a covered call by paying less cost. And you end up taking a higher percentage risk because leverage works both ways. That's why I don't like using the term poor man's covered call, because a lot of people who do that strategy and teach that strategy, they don't warn their customers well enough that, yeah, instead of buying the stock at 27, oops, sorry folks, at 27 and selling at 28 call to generate some premium and having 26.50 in the position, for example, I'm just going to buy a January 25 call for $4 and sell the same April 28 call against it. And now I only have a risk of 370, 360, 360 instead of 3,000. It's 1/10 the cost. But if the stock falls 5%, you're going to be losing 30%. If it falls 10%, you're going to be closer to a 70% loss on that position. And just as we're seeing here, it's going to take a longer time for the stock to move back up to get back to the gain or the cost you had of that initial call that went out of the money. That's why I just don't like the term poor man's covered call, because it's misleading, and educators I've come across don't teach the downside properly enough, and I get phone calls from customers who watched a webinar about the poor man's covered call, and they're sitting on a 55% loss and saying, how is that possible? The stock only dropped 8%. Lie of leverage works both ways. I use calendars in my portfolio. I use diagonal spreads in my portfolio, Louis. I just don't like the term poor man's covered call because I feel it's too misleading for too many investors because it doesn't address the downside properly or the risk of leverage in both directions. Okay. Yeah, and then Sam's just commenting that this could have been better. We might have considered a strangle or straddle in this position. Can't really go back and change time. Another thing you could consider doing is maybe buying perhaps the stock at 27 or so, and if it does recover as you expect, you profit on the stock position as well as profiting on the calls, hopefully getting you back to break even. So let me backtrack beyond the three things we just talked about. Buying a put to create the strangle to protect it further. Yes, this might have been a better position as a strangle to begin with, but that's hindsight 2020, and I'm not Captain Obvious. Okay, that doesn't help Kaushik now. Buying a lower strike call or two lower strike calls to sort of average down just what you might do with a stock, if and only if you think the stock is bottomed and is going to recover. If you buy more calls now and the stock continues down, you'll lose on all three calls. That's the risk of that adjustment. Poor man's covered call. What we're doing here is not a plan to get back to profit right now, which I think was Louis' comment he mentioned in there too. This is something to try to reduce the cost basis, and if it stays below 30 at April, then what do? You sell a May 32.50 or a May 30 again. You take another 40 cents off the cost, 50 cents, 60 cents, and then maybe you sell a June 32.5 or 35, depending on where the stock is. So you're lowering this cost basis, and hopefully the stock is recovering. But the trick here is that if the stock recovers as you're expecting, don't have the short call open during an earnings event. Close it out or just don't sell during that cycle, because if the stock gaps up, you're going to have a larger loss, triple, quadruple the original risk you took with buying the call at 600. The repairs have their pros and cons. Okay, turning it into a diagonal by selling a lower strike call, which is actually a bearish structure. You've created a bearish spread sort of on a stock you're hoping is going to come back bullish, but it's a repair, it's a defense. Buying a put if you fear the stock will continue to fall further. If you really feel and fear the stock's going to continue to drop further, I'd say get out of the call and buy the put, and then if the stock does fall, take the profit on the put, and then when you think it's bottomed, buy back the call. Don't leave it open. Get the dollar back you can now, and then treat this more of a strangle or straddle that you're legging in and out of as the stock moves. So those are some of the alternatives there. Average down with other calls. Buy the stock maybe if you think it's bullish and you have the capital. Selling short-term out-of-the-money calls against it can help you lower the cost basis consistently as you get closer to expiration, but you have to be prepared to move quickly. The stock starts to move above that short call strike price because that's going to cost you more to close it, and it's going to add to your cost basis. It's not the situation or the direction you want to go. Other ideas that you may be able to potentially apply to managing this long call position, check out our free webinars page, powerop.com/webinars.asp. Go into the options strategy section, and I'm just going to find it here. Scroll down. Managing your long options positions. Management techniques for long calls and long puts when the underlying security moves against you. Managing the position if it's profitable or if the underlying has stagnated. You'll see some ideas there on managing this position. Another idea or set of ideas that might work for you is Manage Your Broken Position webinar under Options Concepts. This teaches you alternative methods for managing a stock that has fallen in price, a covered call, managing a sold put that is now in the money and the stock was put to you. Some of the ideas on the stock position, as far as averaging down, you'll see the stock repair discussed, which may be able to be applied to long calls, but it's a little tricky as well. That might work in your favor. So when you have the time this weekend, check out those other archived webinars. The Manage Your Broken Position under Options Concepts, and way down here, Managing Your Long Call Positions, Long Options Positions from 2015. Same content I would present today. Final thought on that, final management technique we sort of didn't discuss. Close the position, take the loss, look for a stock that has a better trend in it right now, and trade long calls on that to hopefully make back the loss as well. Yeah, sometimes the stock wins and it's better to use the remaining premium and start a new position. Exactly. Could you actually roll down the call instead of averaging down? I could sell to close the call for $1 and then buy the lower strike ones as well. Okay, so those are my thoughts there on managing the long call that was $6 per contract, now down to $1 on IQ. All right, Fernando. All right, Fernando says, if you're short on a stock, instead of using a married call, what structure do you suggest to minimize the risk? If I'm already short stock, I would use a married call, Fernando. I'm sorry, your question was easier than I thought it was. In the webinars that we teach for Blueprint owners, the members-only webinars when we talk about playing the bearish side of the market, what Kurt and I refer to is that if I was bearish, I wouldn't necessarily open a married call. That's the last choice I would do to do a limited risk position by trying to short stock. There's alternatives that are discussed in that members-only webinar at RadioActive Trading. If you're already short the stock, then yes, you'd want to protect it by buying a call to create the married call, or by buying a call short-term out of the money and selling a put short-term out of the money to create a short collar. Okay, so we'll take, oh, sorry folks, we'll take match again. And let's say I'm short 100 shares at $55. So what I might do in that scenario is sell, well, this only has 5 strikes, so it makes it easy. Sell the 50 put out of the money, buy the 60 call out of the money. I'm not getting enough premium to do this. It'd have to be 55 to 60. Okay, so I'm going to sell the 55 put at around 2, buy the 60 for around 55. You've created a short collar. I have a risk of only 6%, but I've capped the gain to 2.9% to the downside. Okay, you could do the married call, and I'd follow the same ideas, but just flip it. I'm short the stock. Might go out to September. Buy the 50 call would have to be in the money, 150 days out. Yeah, max risk of 10.4% if it goes against you, but still the available profit to the downside. I only do this if I'm already short stock, and I'm never in that situation, just personally. But if you're already short stock, then yes, you'd want to buy the call to create the married call. I just don't do this off the front. I'd rather maybe just buy a put and put cash aside, or do one of the other structures or other approaches that's talked about in that members-only webinar for Blueprint owners and Fusion subscribers called Playing the Bear Side of the Market, how we like to look at the bear side of the market with limited risk in that situation. Okay. Yeah, Sam agrees with me. Don't short the stocks, buy puts, but if you're already short, yeah, or buy inverse ETFs. Buy calls to the inverse ETFs. I'm sorry, that's what you're saying, Sam. Yeah. Okay. And then Sam, you also added your other comments in regards to Wage and Vikings Therapeutics, I believe it was. ATOP, ATOP. All right. Well, ladies and gentlemen, we're at 5:45 p.m. Eastern Time. I don't see any other questions come through. We took care of Luis. We took care of Kaushik. We took care of Fernando. Answered John's questions, spent the beginning there, talked about Sam's trades and Sam's concepts on, excuse me, folks, Sam's concepts on using the strangles depending on your outlook on positions, and of course, maybe just the idea that we always have to sit back on. Let's be honest, we're options traders and we have a myriad of potential things we could do. I'm sitting on this position and I'm saying, well, I've got all these things around me. I can sell a call against my call that's losing. I can sell a put against my call that's losing. I can sell twice as many calls against the call that I'm losing and buy another call to create a butterfly. You could do all these wonderful things. Some of them may work as a repair, but it's all dependent on if the stock does X next. Will it get you back to break even if the stock moves back up? Yes. Will the stock move back up? I don't know. Did you take on too much more risk? Did you double or triple your risk in one direction if the stock doesn't do what you wanted? Maybe that's not a good repair, and that's what we want to analyze when we go forward to consider adjusting positions and managing them. Is the repair worth it if we're wrong? Sometimes it's just not. It might be okay just to take the loss on the position, move on to that strategy, you know, the long call strategy or calendar, poor man's covered call, as we talked about. I prefer the term diagonal spread or calendar spread. But again, oops, sorry, folks. Make sure that you're not doing a repair for the sake of the repair. It might not be worth the repair if it doubles or triples your risk, because now you're sort of, my apologies, you're sort of shooting yourself in the foot because you agreed when you opened the position that you were only willing to risk a certain amount of capital. That's $600. That's $600 times 3 contracts, $1,800. Now, if you double that risk up to $3,600 or triple it up to $5,400, and you take that loss, or you take 90% of that new $5,400, how bad did that just destroy your trading plan? You were in this with I know I might only be right 50 to 60% of the time on buying calls that I hope to move up, but as long as I control my risk to this amount, don't lose more than 40 or 50% on each long call, I should still be able to be profitable long term. Well, now you've just tripled the risk on one, and you took 90% of that tripled risk. You just wiped out 3 times as many trades as you would have with one single loss, probably put you 3 to 4 months behind. Okay, so we want to make sure that we don't do a repair that increases the risk too much, even if it gets us back to break even faster. We want to play both sides a little bit. All right. I just want to remind everyone that today's material are my thoughts on your questions designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct trading suggestions or recommendations. And I pinpointed the 2 puts, of course, that I would use on Match Group if I was opening a position on Match Group today for John. I also point out that I would personally not open a married put on Match today, and I showed why. But following the rules in the blueprint, I detailed what strategy, what strikes I would use if I was following a radioactive trading technique on that particular stock. It wasn't a recommendation. It's following the rules in the blueprint for proper structure. And then the I to why I wouldn't do it. In any case, options do involve risk, as we talked about a lot today, and talked about ways to solve those risks that may not be suitable for all investors. Today you saw a brief look at the search tool when we were doing the married puts. the links to use to further research and analyze a stock and run what-if scenarios with the profit and loss chart. We talked about the spread chain tool to compare parity trades for vertical spreads. We also showed the power of that long option finder. If you'd like any of those tools to be able to help with your portfolio and help your decision making, just go ahead and take a trial. Go to PowerOp.com, put in your name and email address. You'll have full access to all the tools we saw today, plus many more for 14 days, no credit card required. After that, the subscriptions start at only $40 per month. We do have various levels of subscriptions for your trading needs. If you're doing weekly spreads or weekly options trades, you probably want to go to the real-time service. But if you're just doing a few trades here and there, you're doing monthly trades or even trades every 2 weeks out, a 20-minute delayed service might be perfectly fine for you as well. And then, of course, we do offer full historical tools for backtesting purposes as well. I showed you where to access those webinars on managing your broken position, stock repair, as well as managing your long calls, and managing spread trades was there too. PowerOp.com/webinars.asp is a free resource. You don't need a login. You can go to the webinars page at any time. Also, you can check out our blog for other free education, blog.powerop.com. Remember, most of our videos are archived also on YouTube, so you can look for Power Options on YouTube to see some of our recent and past discussions as well. Questions? If you think of any other questions later on this weekend that you didn't get to ask today, remember, send me an email at any time to support@powerop.com or to support@radioactivetrading.com. You can also call us during office hours at 302-992-7971. And as we talked about earlier in the beginning with the 4 check marks there, if you are a trial member or a subscriber, then just go ahead and schedule a coaching session at any time. It's a 35 to 45-minute phone conversation with myself or Ernie, and we'll walk you through the tools on the site and answer any questions that you have. All right.